Welcome to another housing debrief. It is Thursday, already into August. We're well into August. As a matter of fact, we're so far into August that my kids are going back to school. You know what that means? That means that summer is just about over. So, yep, that's right. We looks like summer is done. Two of my kids went back to school today. I have a kid leaving for Washington State University on Sunday, and then next week I have two starting middle school. It will be just my wife, myself, and Zeke for the next few weeks until he goes back to school in September. So, yeah, very, very hard to believe. So anyways, I hope everybody's ready for a fantastic weekend. It's going to be hot, so I'm sure everyone's going to be heading to the beach and the pool and all that good stuff. I wrap it up usually on Thursday, and then Friday I'm just doing a little bit of office stuff, and it works out a lot better. However, next week I am busy on Thursday, have a lot of presentations because we're back in the swing of things. July is done, and that's when I took the entire month off just about, other than putting together the reports. And next Thursday I have a conflicting meeting, so we will be going live instead on Friday. So stay tuned for that. So Friday at 3:00 p.m., we will be going live next week instead of Thursday. So let's go ahead and share the screen and let's get going. I wanted to talk about what's going on in the housing market, and it is definitely a big. There's been some changes afoot. So let's see. All right, looks like I put the wrong. Have the wrong clicker in here, so bear with me for a second. Apologize for that. That's kind of silly. Have a backup clicker that is out of batteries. So here we go. Oh man, there it goes. See, now we're all of a sudden we're making some headway here. Anyway, let's go backwards. All right. So housing debrief. And I want everybody, I invite you to just smash the like button and subscribe. Go to YouTube, Reports on Housing on YouTube. You can watch this on Facebook, but everything is housed on YouTube. And we just want to get the algorithms going so that our reach is a lot broader than where we are today. So just want more people to be able to see it. It's not like I'm going to be making money on YouTube. It's just that I want to see that people actually get the true narrative of what's going on in the housing market from a housing analyst. And I did have somebody this last week wonder if I just play my cards right so that people will subscribe to my housing report because my audience is a bunch of real estate agents, right? But I want everybody to have the accurate data and exactly what's going on in the marketplace so we can make great decisions for our families. And if we set everybody's expectations of what to expect, they can make those decisions. And you know, that's the way that we make the best decisions, is by having as much information as possible. So that's what we're trying to do here. And so I invite everyone to subscribe, but we're going to start off with a couple funny slides. One of them being the early in 2022, no FHA offers. And now all of a sudden, everybody's willing to do an FHA offer. And sitting on the market, right? This is what happens when you are sitting on the market. Yeah, so you're basically waiting for somebody to come and to purchase your home, and it's just not happening. So there's a lot of people that fit this boat. Those are the people that are overpriced, and they are not approaching the real estate market in the right way, and that is by carefully pricing. Can't stress anymore how important it is to price it right in this kind of a marketplace. So definitely want to do that. Housing slowdown has stopped. And I want to explain what's going on. It's been an absolute roller coaster ride this year. And we saw that with all of a sudden from day one of this year, it felt like the market was totally changing. And sure enough, that's exactly what was happening. And why my clicker's not working, but it's been like a roller coaster this whole entire year. We've had the market has been this twists and turns, and it's really slowed. It looked like it stalled out right around April, May of this year, and the markets have just totally been slowing. So as a result, I wanted to talk about what's going on based upon what we're seeing, and that is the speed of the market really does tell you what's going on in the marketplace today. And I'm going to go over the Southern California expected market time. That is, you place your home on the market. When are you going to open up escrow? That's what everybody wants to know right now, is when are we going to open up escrow? So, but first, of course, I want to explain the geek that I am. I've had a lot of people ask, what is this expected market time? Is it just days on market? And it is not a days on market statistic. The statistic takes into consideration the available number of homes and how many homes we're placing into escrow right now. So within the last 30 days, it's a recent snapshot of escrow activity. When you take a look at the supply and then the demand based upon escrow activity, if all of a sudden escrow activity were to slow or to increase, you're going to see a change in the pace of the marketplace. Same thing happens when you see inventory all of a sudden come on or come off. You're going to see a change in the pace. And when you put those two together, you come up with the expected market time. It has nothing to do with average or median days on market. Those statistics do not tell you enough about what's going on in the market. It is not the true flavor of what's going on in housing. And so basically, it's been up and away as far as the market's concerned. The expected market time has been growing. It's been taking a lot longer to sell a house. And this is where we are today. And if I draw a line across, it is just, it's a lot higher than where we were at the beginning of the year. And as far as the expected market time is concerned, you can see we're right now at levels that where we have been before in recent years. This is not like 2020 and 2021. It's taken a lot longer to sell houses. But below that 40-day threshold, that is that red line right there, that is where the market is insane. And we were there for quite some time. It was about June of 2020 all the way until May 26th of this year. So nearly 2 years where the market was absolutely insane. And that's what everybody's been used to. And now that has since changed. It is no longer insane. It's no longer multiple offers. We did have this at the beginning of the year, but around May is when this changed, where people were, there was, you get like 10 offers on the property, it would go an extra 50 or an extra $100,000. They've even seen some that were going $200,000 above the list price. And that is that froth that I was referring to at the beginning of the year. And I told people not to purchase that froth, because now those are the people that are losing. And a lot of people say, well, it's not selling as high as that one that sold earlier this year. Well, that's because buyers are looking at other homes in adjacent neighborhoods, maybe not that specific neighborhood, but adjacent neighborhoods that are priced lower. And now that if you price a home based upon that last comp in that neighborhood where they got an extra $100,000, you're going to be sitting on the market. It needs to come back down to where all the other comparable sales are. So that's what happened. That's what's happening right now. And some people say that means the values are coming down. No, it doesn't. That means that you shouldn't have participated in the froth at the beginning of the year. And so from May 26th until where we are right now today, this is, or where we were around June 23rd. So for a month, we were at a hot seller's market. So we went from an insane market to a hot seller's market. And that's where values continue to rise, but they're not rising at that speed, that clip that was just absolutely insane. But they're still going up all the way till June 23rd is what what we were seeing in the metrics. But then the metrics changed and evolved even further. And what we had instead was this, we're between that 60 and 90 days. That 60 and 90 days is actually a slight seller's market. And people go, how can it be a seller's market? I heard everything slowed and values are coming down. And that's just not really what the case is. Instead, we are right here. And this is where you have to be very, very precise on when you're pricing your property. Now you have to take into consideration the property's location, its condition, the amenities, and you have to take a look at everything. It's no longer, this is my home, I want to get an extra of this much more than the last person. And then the bunch of real estate agents were scratching their head going, there's no way we're going to get that. It's going above what I suggested. And they still had like 10 offers and they still went another $25,000, $50,000 above the list price. So that craziness is gone. And now if you stretch your asking price, you're going to sit on the market and you're going to have to adjust that price maybe once, maybe twice. And because you do that, you actually lose out on equity by having to reduce the price down the road, because the most bang for your buck is right at the beginning when you come out of the gates. And that's why you should spend hours coming up with the price, taking in consideration all the comps. And if this one had this kind of a view, but didn't have this, and mine has this, and that one doesn't have that, you have to take into consideration everything. And between 90 and 120 is a balanced market. And that's where I thought we were going to go, but things have changed. We're not going to get there this year. And above 120 is where up to 150 is a slight buyer's market. I thought we could even get there, but that changed. This all was a big giant sea change from June to where we are right now, from mid-June to where we are. So it took the better part of last month to figure it out while I was off and say, holy smokes, I thought we were going to balance. I thought we were going to have a buyer's market where, our lemonade's 50 cents. She might have to bring down the price to 40 cents, maybe, a little bit less, that type of thing. So they're going to have to reduce their price in order to sell, and we'd have values come down if we were at a buyer's market for a long period of time with duration. But that's not happening at all. Instead, we have a slight seller's market. There are still people looking. Yeah, I don't know if I'm going to purchase, but people are buying. They're not in a rush to purchase, but it's still, there's enough demand out there and there's not enough supply. And we'll get into those details. The Southern California expected market time, you could see it right here. On March 17th, we were at 24 days. And one week ago, we were at 76 days. So we definitely slowed it. It was, if we could deplete the whole entire inventory in 24 days for all of Southern California, that is an insane market. Now we're at 76 days. Now it takes, over 2 months in order to deplete the entire inventory. That's what we refer to as a slight seller's market. But it actually, I had reevaluated all the numbers, because I do these things on Thursday morning, and then we actually take the real numbers Thursday night. So after looking at this, we actually had the expected market time drop from 2 weeks prior to last week by 1 day, from 77 to 76 days. And last year, we were at 33 days at the same time period. So a lot hotter. Everybody remembers how hot it is. And that's why this has changed. And it feels like everything's slow. And it's because we're not selling as many properties and demand is way down, but there's still not enough inventory. That's really what the story is. 3-year average is 74 days. So we're right there at that 3-year average. But what happened I don't know what I just did. Let's see. That was weird. Okay, sorry about that. So what happened is this. We actually, within the last week, we actually dropped even further, down to 74 days. So we dropped 1 day. Now we're dropping 2 more days. We're down to 74 days. So actually, within the last 3 weeks, if you looked at the market 3 weeks ago to where it is today, the market is a little bit hotter, and it's been getting a little bit hotter. It's not like it's gone insane. It means that we've stopped slowing down, where it was getting longer and longer and longer to sell the house. You could see it right here up at the top where the arrow is pointing. You can see how it's flat. That flat means that it actually went down by a day, and now it's gone down a little bit further within the last week. And where are we going to go from here? We're probably going to go down a little bit more. We'll readjust, and then it's going to be flat, which means that the market is no longer going to continue to slow like we had anticipated earlier this year. And I'll tell you what the big change was, because we've reached a cruising altitude. It's no longer, it's like continuing to climb, continuing to slow, and now the wheels are going to come off. That's not what's occurring. So we're going to take a look at it. In Los Angeles, it went from 78 to 76 days, down 2 days in the last week. And in Orange County, went from 67 to 66 days, down 1. Riverside from 75 to 77 days. It's the only county that actually increased by 2 days within the last week. San Bernardino County went from 91 to 88 days, down 3 within a week. San Diego from 66 to 62. That's down 4. And Ventura from 58 to 53, down 5. So that's a big shift in just the last week. So we're seeing that the market is speeding up just a bit, and it's now moving at a little bit faster clip. You're wondering, what in the world is going on? Well, let me explain what's going on. But first, I would like to thank our sponsor, Jason Thibodeau with JMJ Financial. He can be reached at 714-330-8263. And he's the branch manager, and he does an incredible job. They have a few different programs. One of them is earnest money deposit insurance, where they will ensure that you get your earnest money deposit back. If it was to fall out, there is an upfront fee, but you get that back at the end. So it's a removal of all loan contingencies, closes in as few as 5 days, and you get the fee refunded once the loan closes. And then they also have this lock and shop, because everybody's wondering, my gosh, when rates get down to a lower level, they go, I want to lock this. You actually can. It does cost a little bit to do it, but you can still shop if you're not already in escrow, and there are fees involved in this. They lock the address as TBD. Home buyers can shop without susceptibility to rising rates. And then they have a 2-1 buy down mortgage. And that's just, you know what, if you want a lower rate, maybe you get mom and dad or somebody else, if you're a buyer, to help out. You can put money up front and actually buy down your interest rate. And they have a lot of different programs here that will change what your rate looks like just by buying down that interest rate. And that will, now that interest rates are floating down a little bit and you buy down your interest rate, you're getting interest rates closer to where they had been in the past. So those are great programs. So their methodology is simple. We don't make promises we can't keep. So Jason Thibodeau with JMJ Financial, contact him, 714-330-8263. That's 714-330-8263. And thanks again, Jason Thibodeau, for your continued sponsorship. So let's get back to the nerdy explanation of what's going on and why the market is no longer slowing. I said the expected market time has slowed. Well, what in the world's going on? Well, I'm going to look at my crystal ball, and the best crystal ball to look at is inventory. Inventory tells you the story. It's where the inventory is going. And that is really what has happened. We had no inventory. We added more inventory. So let's explain it. It's the supply and demand thing. So we've already seen demand come down quite a bit, and we've seen the supply increase. And that is why when you have demand coming down and supply increasing, the market takes longer and longer to sell your home. So the market slows. Well, and that's pretty much what's happened. We've seen a shrinking inventory, and we got to at the beginning of the year down to levels that we had never seen, historic low levels for modern times. And it went from a supply crisis to a supply catastrophe. There was just almost nothing on the market in most all Southern California counties, and across the United States hit a record low in the number of homes available. Now, the Southern California inventory, you could see this. It did come up. It shot up quite a bit. But you could see at the very, very tippy top, it was kind of curving. And that's exactly what's happened, is we've seen the inventory stop growing. And that is not what we were anticipating, because we had much higher rates with duration. And you could see last week we went from 31,100 we had 31,169. It was up 3%, or up 636. We were going up at a very, very fast pace. Like it was going up in the thousands, like 3,000 for a week. And now for 2 weeks, now we're down to 636. That's up 3% in that 2-week period of time. It was the smallest rise since March. And you could see at the beginning of the year, it was slow. And then we got to at the end of the March, and then it started to go up, and now it is slow again. And last year we were at 20,458. That's 34% less than where we are today. And the 3-year average is 41,165. It's 32% higher. And that 3-year average is 2017 to 2019 prior to COVID. That is a lot more homes that we're not going to get to. We're not going to get to pre-COVID levels. And I thought we were going to get there before, but something has changed. Another shift in the market. Today, we're at 31,420. That's up just 0.8% in the week. So you can see that the velocity is slowing, and we're starting to hit that peak. And I'll explain exactly what's going on, because this is what we anticipated. I anticipated this. As long as we had the interest rates that continue to go up, and they were going to stay high with duration, we were going to continue to see the market slow. And we were getting that. The inventory was continuing to rise. But with changes afoot, and I'll go into those changes in just a second, what happened is we're going to get the normal peak. we don't typically peak between October and Thanksgiving. That's what happens when we have interest rates rise with duration. We have demand slow, we have inventories rise, and it continues to rise even past where the normal peak is until we get to the fall. And that is between July and about the third week of August, which we're very, very close to that. And that's why it looks like we're achieving that peak. And then when that happens, what we're going to see is we're going to see that the inventory starts to drop, and then it drops even further. Oops, I forgot I did this twice. So this is exactly what I was telling you about. It happened in 2013, and that was where interest rates rose, and we had the inventory rise as a result because demand had fallen and market times had grown. Same things happened this year. We had the interest rates rise. That's that gold dotted line. And then we've had the inventory rise too. But you could see right here what's happened recently is the interest rates rose. They got all the way up to 6.28%, and now they've come down. They've even come down as low as 5%, but they're kind of seesawing around. But it was enough where it's come down enough where it's added to the buyer pool. So that's the story, interest rates. Interest rates is kind of like as interest rates turn, because here's all these soap operas that no longer exist, but there's so many that are out there. And this is a new one called As Interest Rates Turns. Tune in every single day. Yes, you too can watch what interest rates are doing on a daily basis. And what's happening is the overall economy is slowing down. And when that happens, that's when we start to see a change. And this change is in the 10-year Treasury. This was as of today. You could see the 10-year Treasury has come down from where it was in June at a height where it was near 3.5, and then it continued to go down. And the appetite for the investor that is looking at 10-year treasuries is the same investor that's looking at mortgage-backed securities, which is why when 10-year treasuries go down, typically interest rates go down. When 10-year treasuries rise, interest rates rise. You can see it rose earlier until we got to mid-June, and now it's coming back down. And you could see the same thing in the interest rates. You could see it's going down from a height of 6.28% to where it's at today. And you can see what's happened here on the right-hand side. There's kind of been like a yo-yo of interest rates. And I would get in the weeds if I explained why. I've done a lot of studies as to why that happens. And there's some really, really smart people that I tune into that explain it. But I would get in the weeds if I was to explain it to everybody out there. But just know that there's a lot of volatility on interest rates. And it is where we went from, you could see on the right-hand side, it's gone from where we are at 5.5. It was at 5.7%. Then it got down towards 5.5. Then it dropped to 5. Then it went up to 5. Then it went back down to 5. Then it went back up towards it was 5.45%. Then it went back down. Then it's come up a little bit. Right now it's at 5.27%, which is a whole point less than where it was in mid-June. So that is the point, that it's a lot less. It's now the highest interest rate since August of 2009, but we were looking at interest rates that dated all the way back to 2008 when we just got into the recession. So interest rates, there's some pressure on it to come down, but it is waffling all over the place. But it's staying right now in a kind of a really tight channel. And there are a few things at play here that's improving things like, well, one of these is I wanted to show you this because this didn't improve things at first when we got this, because how about this? This is why we saw the seesaw of interest rates. They went a lot higher and they spiked after the job report when it was estimated to be 250,000 and instead came in at 528 in a 2-month period. We added over 900,000 jobs. Doesn't sound very recessionary, does it? And these jobs are in all different sectors. We look at that because we're economists. We don't say that, oh, yeah, it's all the lowest paying jobs, because that's what a lot of people like to do without even seeing the data. We've seen the data, and it's coming from all aspects. The overall theme of employment being strong continues to this day. But the U.S. inflation numbers came out, and this was a kind of a surprise. It was an actual beat as far as it coming down. And so the headline inflation is down to 8.5%. So it's starting to come down. It looks like we're starting to see a peak. This is only one number, but it looks like the Fed might not have to do that 3/4 point bump in September. It looks like now it's looking like a 0.5% bump. That's in the short-term rate. That's not long-term mortgages, by the way. That's automobile loans and credit card debt, equity lines of credit, not 30-year mortgages. Know that when they go up, it's already built into the market. A lot of times interest rates actually fall. But nonetheless, this means that they're probably going to go from 3/4 to a half in September. And they were planning always doing a half, but they were going to have to do these 3/4 because inflation still, they haven't got a handle on it. But it looks like they might be getting a handle on it. But one print is not enough. They're going to need several to map this out. And that would mean that they would start to cool their policies. But so it's going to be all systems go for a while for the Fed still. But this is a step in the right direction. And know that when we actually have, if we go into recession, things slow down further, that every time we've had a recession, guess what happens to interest rates? They drop further. So if that's the case and we go into recession, we can anticipate rates going down even further into the 4s is what we're thinking. We could even see it get down to 4.5, maybe even less than that. And you know what that would do? That would change quite a few things. That would open up some demand channels. So inventory change in 1 week, Los Angeles actually only went up by 1%, 105 additional homes. Orange County went up 66, that's 1.6%. Riverside up 105, 1.7%. San Bernardino up 69, 1.3%. And San Diego's down 94, down 2%. Ventura down 16 or down 1%. So they're actually down. Their inventories look like they probably have already peaked. San Diego's usually my barometer for what the rest of the market's going to do. They typically do things first. And how about some price reductions out there? So across the United States, 37.6% of the entire United States U.S. single-family homes have reduced their price. In Los Angeles County, all homes, townhomes, detached, everything, condos, 35% of everything available has reduced the price in Los Angeles County. In Orange County, it's 39%. In Riverside County, it's 42%. In San Bernardino County, it's 45%. It's almost half. And in San Diego County, it's 40%. And in Ventura, it is 39%. So I don't know why I have this on here twice. I did that again. That's twice I've done that. Demand. Let's talk about demand. So what happened is with interest rates at 6.28%, there were not as many buyers. So it wasn't as many fish looking for homes. So there wasn't as many buyers in the marketplace. But as interest rates start to go down, we add more buyers to the pool. And with more buyers to the pool, that's why we start to see demand come up. And it can also, because demand's coming up, we're watching the inventories kind of hit their peaks. And Southern California demand last week was at 12,329. It was actually up 4%. I had to reevaluate this. Up 4% or up 430 pending sales in that 2-week period of time. And it was the first rise since mid-March. And last year we were at 18,466, so 50% more demand. That's pending sales. It's recent pending activity the last 30 days. And the 3-year average is 16,757. That's 36% higher than where we are today. So the big thing is yeah, we have demand that's kind of way down there still. It's still down there, but we're pitting it against really low supply. So when you pit low demand against low supply, that's why the market isn't overly, it's not turning into a buyer's market. So today we're at 12,745, up another 3%. And where are we going to go from here? Looks like demand's going to rise a little bit, and then it's going to fall once we get towards Thanksgiving. And if you want a copy of this, you need to be a subscriber. I invite you to go to reportsonhousing.com and subscribe. You'll automatically get a copy of this, a PDF version of it. And where do you go to subscribe? Reportsonhousing.com. Go there to subscribe and utilize the code. Oh, we have report the dot all over Southern California. It's still working on the Bay Area. Putting together 9 counties is a bit of a feat. And it's $15 per month or $150 per year. And you get a month free if you utilize the coupon code August. And the last one that came out, it's called No Bargains. This was for LA, Orange County, San Diego this week. Next week, San Bernardino, Riverside will get this. And what I mean by that is that we're still in a slight seller's market. We're not in a buyer's market. So those people that are looking for bargains, as long as people price their homes right, they will sell. But it needs to be priced according to their condition, location, amenities, upgrades, all that stuff. It's no longer you just get to throw a number out there and get it. You have to be very meticulous and come up with the exact fair market value when you come out of the gates. And if I was a buyer looking to buy right now, I look for something that's been on the market for quite some time. So if you want some free content, we're throwing up a lot of free content at reportsonhousing.com. Just click on the free content section. You can get that as well. That's all I have. So I invite everybody to, you know what? subscribe. And if you're not a subscriber, have a great rest of your Thursday. Have a great, super finish your week. If you have any comments or questions, put them in the chat. I'll be more than happy to respond to anything that you have out there. And I hope you have a great rest of the week, and we will see you on the other side.